little tables that look like T accounts. If you want to just empty my numbers out and then cut and paste those numbers and do those, you could set up an Excel spreadsheet. So again, it looks like a T account. Or you can do it neatly, handwritten, scan that, and submit your supporting work that way. But I'm not just interested in your final answer. I want to see enough work that I understand the process you went through to get that final answer. Now, you might be saying, well, wait a minute. In this exercise, you're not giving me the cash flow statement. In the real world, I'll have the cash flow statement, so what's the point? The point is this. The purpose of this exercise is to develop your skills, develop your understanding in putting the parts together. Because that's what happens when, after this course is over, if a set of financial statements comes across your desk, we want you to be more likely to sit down, get out a sheet of yellow paper there, start drawing T accounts, and start analyzing it to make sure what? To make sure the pieces all fit right. It's when you do that detailed analysis that you're going to be more likely to catch those attempts at earnings management, income smoothing, or just outright accounting fraud. Because one piece can look okay in isolation. It's when you start to put the pieces together that it doesn't appear to fit. And if you're analyzing something and it doesn't appear to fit, to say, well, I've got a headache, I'll stop. Maybe you should stop until the headache goes away. But then you should come back to it. Because if you're analyzing anything, whether it's financial statements or something else, if you're analyzing something, it's like, it just doesn't look right. Things don't look like they fit. You stay with that until you come to a resolution. You're just walking away from it. That's probably going to reach up and have an unpleasant consequence later on. Okay, that is operating activity. Now your second assignment is going to be investing activities, financing activities, ratio analysis. Fortunately for us, the T account analysis for investing and financing activities is much less involved. Why is that? Think about transaction volume. Of those three groups of activities, operating, investing, and financing activities, which of those three areas by far has the greatest transaction volume? It's operating activities. The other two are very, very minor in comparison to that. We're at 10. We're going to stop 5 over. We're just going to stop there and give you a break because that's a good stopping point. So what we're going to do this afternoon after lunch is we'll do Robbins Boutique, the example, through operating activities. Then we'll give you the framework for investing and financing activities and ratios, and then we'll use the rest of our time to finish up Robbins for investing, financing, and ratios. And when we leave this afternoon, I'm going to give you a few extra hints, because they're not really tricky things, but there are a few, I call them little fun things that I put in the Bauer example that, I just don't want to make it like too much fun, with the holiday season and such. But we're done for now. Okay, gang. Last night, about a little less than 12 hours ago, we ended our session, and sort of the theme from last night was that to get all the information possible out of financial statements, you've You've got to understand it's one puzzle. You need to fit all the pieces together. But last night, we looked at that more at a big picture or a macro level. This morning, session 1, we want to go more micro, looking at fitting little subsets together. So, first thing we want to look at is I want to look at receivables. Now, not every sale is going to be a sale on account. So that's okay. For analysis purposes, though, we can assume that it is. But for any business, here's the deal. Sales need to turn into cash receipts. It's like the tree that falls in the woods. You know, if nobody hears it, does it make any noise? If you have $1 of sales, but you never collect that dollar in cash, did that sale really do you any good? No, it didn't. So, what stands in between sales revenue and cash receipts? Well, accounts receivable is the balance sheet account. And this is what we're going to see as we do this analysis. This is on the income statement. Cash receipts going to be on the cash flow statement. Accounts receivable is going to be on the balance sheet. So this is going to be, I think, one of the interesting things about the accounts that we look at. One particular account from the balance sheet is going to tie together information from the income statement and the cash flow statement. Now, eventually, just for fun, complicate this a little bit. Looking ahead to your assignment that you're going to do and turn in for me, we're going to look at how the notion of bad debts enters into all of that. But we're not going to do this right away. Let's get a basic framework, understand it, and then add pieces to it. We have technical difficulties. Let me get Wendy. I've hit the little button to clear the screen, but it doesn't want to do that.
The new page?
Yes. It just sits there and looks at me funny. I mean, this thing here is that, but I'm going to click on that, then do anything. Okay, I knew it was a clicker.
You gotta click over here.
Over here, I was hitting in the middle.
Yeah, no, sorry, over here on the far.
Oh, so this is like one of those liberal mouse pads.
To the left.
Should have warned me.
Very good.
I promise you, I do not have any left-leaning laptops.
We don't allow those in Texas, you understand? Okay, our idea of a liberal in Texas is John Cornyn, you know, and then Ted Cruz is conservative. Okay, so let's go ahead and set up accounts receivable. This is arguably your most important account out there. Okay, now, at least 2 of you have had accounting background, and the rest of you, at least officially, you took that Ivy software prerequisite, or sometime in your past, you had an accounting course. You may not remember it, but your transcript says that you did. But remember, debits go on the left, assets have debit balances, and that's just the way things are. So what we're going to do from the balance sheet, from the beginning of the year balance sheet, we get the beginning balance in accounts receivable. Then, from the end of the year balance sheet, we get the ending balance. Now, what we see here, and this can either go up or go down, when we make a sale on account, what does that do to the balance of accounts receivable? Cause it to go up or go down? Go up. Very good. Now, whenever I write that, every so often a well-meaning undergraduate student start waving their hand frantically, me being just excited that some student wants to participate at the undergrad level, excitedly calls on them, this, but sales have a credit balance. And I'm like, A for the day. We're not saying here that sales has a debit balance. What we're saying is this sales revenue, a sale on account, is the reason accounts receivable went up. So we're analyzing this account, and when we write something in it, we're telling you where that amount came from. Same idea over here. When cash is received, the cash account goes up and accounts receivable goes down. So all that is, it's in the form of a T account, but all that really is an algebra equation. The beginning balance plus revenue for the year minus cash receipts for the year equals the ending balance. Now, if you know 1, 2, 3 things, can you solve for the fourth? Yes. See, here's what we're going to do. Last night, when we drew that sort of diagram of how all the statements fit together, before we put the 3 parts of the cash flow statement, the operating, the investing, and the financing activities, we had a big old open space in our diagram. And then the cash flow statement filled that in. But what we're going to show you here is that if you know what you're doing, if you just have an income statement, beginning and ending balance sheet, the cash flow information, even before the cash flow statement was prepared, the cash flow information was already there. See, if you know this and this from the beginning and ending balance sheets, if you know this from the income statement, don't you implicitly at least already know this? So that is going to be part of your first 2 assignments. You are going to determine cash flow information without looking at the cash flow statement. Now, why am I doing that? Just to torture you during this holiday season? Do my best imitation of Scrooge? Well, actually, no, because the assignments are not due till after the holiday season, so that wouldn't actually fit either. But no, there's nothing quite so sadistic. The purpose of these first 2 assignments is for you guys to work with the pieces of the model. As you guys work with the pieces of the model, that's going to reinforce your understanding of how those pieces fit together. So that's what we're going to be doing. So, pretty straightforward stuff here. Now, let's see here. Carburetor, 69 Camaro. Okay, remember, you had to pay for that in advance. So, that that cash flow situation wouldn't run through accounts receivable. Okay, let's try the lower left here. There we go. Okay, so unearned revenue is another account. Now, all the accounts we're looking at up here today, all these accounts are non-cash current assets or current liabilities. And what did we say the purpose of those two categories of accounts was last night? Their purpose is to take up the slack so that revenues are recorded when they are earned. That's not necessarily the same time as the cash is received. Expenses are recorded when the item is used up. That's not necessarily the same time the cash is paid. Standing in between to take up the slack, non-cash current assets, current liabilities. Okay, why did I put the balances on the right-hand side over here? Because it's a liability. Liabilities have credit balances. Now, Steve went in last night and was getting his carburetor. They made him pay in advance. So, the company receives cash. Cash goes up, and now the company is liable or obligated to Steve. So this liability goes up because cash has been received. Eventually, carburetor comes in, they call Steve, he comes in and picks it up. They deliver the carburetor to Steve, delivery of the product, key step in revenue recognition, they have sales revenue. So again, same idea. If I know this, this, and this, I could solve. If I know this, this, and this, I can solve for the cash flow information. So what you've got on the revenue side of things here, you've got two accounts. Let's put those up beside each other. Two accounts take up the slack. Okay, now this account is used when the sale happens first, the cash receipt happens second. This account is used when the cash receipt happens first and the sale happens second. Hence over here, sales revenue is followed by cash receipt. Over here, cash received is followed by sales revenue. And again, it all fits. See, notice, whenever cash is received, the cash account is always debited. So when cash is always debited, something has to be credited. Over here, when the sale happens first, the receipt of cash reduces the balance, account receivable. Over here, where the cash is received first, receiving cash increases the balance in unearned revenue. Same way over here, when a sale happens, sales revenue, yes, it has a credit balance. So when you credit sales revenue, you have to debit something else. Over here, you debit accounts receivable. Over here, you debit unearned revenue. Over here, since this is an asset, sale on account increases the asset. Over here, it's a liability. The sale decreases the liability. Or another way of saying it, the unearned revenue becomes a earned revenue, if you will. Now, what if you've got sales revenue of, say, $1 million. And you've got both of these accounts on your balance sheet. Okay? Now, I'm just making these numbers up. So, I know 5 things. Beginning and ending balances of this account, beginning and ending of this account, my sales revenue. I want to come up with cash received from customers. Okay? I've been captured by Islamic extremists. They said, capitalist pig, you die unless you can tell us cash received from customers. Will you live to see the next sunrise after the clouds and the snow move out? Of course you will. So the question is, what do I do with this? Well, sales revenue shows up 2 places. Whatever number you write here and here has to sum to 1 million. And there's a whole bunch of different ways to do that. Here's what I would do. Over here, this account balance went down by 10,000. I'm going to plug a 0 in there and a 10,000 in there. Why? Remember, we're doing analysis here. We're not trying to actually map what actually happened. What's 15 minus 10 plus 0? It's 5. So that just makes the math easy. So if I put 10 here, I have to put 990 over here. And then this account went up by 40. From 10 to 50. For something to go up by 40, this has to be 40 bigger than that. $10 plus 990 is $1 million. $1 million minus 950 is 50. So, in this example, cash received from customers is 950 plus 0, or 950,000. But, you know, if 812,000 is your favorite number, and you like to use it every time you can, you can put 812,000 here, and 188,000 here, and you will still get 950,000 for your answer. So, when I'm doing something like this, I will break this number up in the way that makes the math easiest. But that's just me. The only thing you have to do is make sure you break it up in such a way that the 2 places where sales revenue show up, these 2 numbers added together equal the total amount from the income statement. But that's how the basic structure for getting cash receipts from customers without ever looking at the cash flow statement. Later on this afternoon, we'll throw in bad debts just for excitement. Okay, now let's move on. Let's look at expenses. Okay, we've got one expense that's going to involve 2 accounts. Won't be terribly difficult, but it will involve 2 accounts. What is typically the biggest expense line item for any business? Okay, especially if you're in a labor-intensive business. But if it's a manufacturing business, so we're going to follow that a little bit, get a little cost accounting in here. If you're a business that actually makes something, and unfortunately there's fewer and fewer of those businesses, this is what's interesting. Wage expense, the labor for your production line employees, does that line item show up as wage expense on the income statement, or does it show up somewhere else? You're saying, I'm not sure I want to go down this road. I'll help lead you. Wage expense, if it's a production line employee, would be part of direct labor. Direct labor, direct materials, and overhead are all manufacturing costs, aren't they? And there's a cost of goods manufactured statement. If this is like a class for accounting majors and I had you for like 30 credit hours, we would go there. Okay? So this is what's sort of interesting. Anything that's a cost of producing a product. So depreciation on the equipment, depreciation on the factory, insurance on the factory, the electric bill for the factory, the property tax bill for the factory. All costs of manufacturing that fit under direct labor, direct materials, or overhead, those all get thrown into work in process. Once the stuff gets finished, it goes to finished goods, sits there until somebody buys it. When somebody buys it, remember that's the triggering event for revenue recognition? Well, if I recognize the revenue, matching concept says I have to recognize the expense that goes with it. So what's the expense that goes with the revenue from selling something? A little louder. With feeling. Cost of goods sold. So you are correct. Wage expense is typically the biggest cost of a business. Unfortunately, this is what's interesting about a manufacturing company. A lot of those big line item costs, they all get dumped into something else. So cost of goods sold. Now, do you work for a business that produces and sells a product and provides a service? Service. See, and that I was expecting, when you said wages, that's what I was expecting. Because for a service business, they don't have, they may not have cost of goods sold. But even there, if you're doing an engagement for a client, you can have direct labor. So you've got these particular folks that are working in this particular job, and they fill out a timesheet and it gets charged to that job. And then you could have an overhead rate that you apply to that job, say as a percentage of direct labor cost, or so much per direct labor hour. Your direct materials may be minuscule. But even with a service business, you could actually have a costing process similar where the direct labor and the overhead would throw in. Not necessarily how all businesses do it, but that could, if you're like an engineering firm or something and doing big kinds of contracts. So cost of goods sold is what we're looking at here. And we're going to look at one inventory account. We're not going to try and look at direct material, direct labor, work in process, and all that stuff. We're going to save that for the second half of the course. But we're going to look at inventory and accounts payable. Good answers this morning, folks. If you're still doing that at 5 p.m., I will be like really like an early Christmas. Okay, here's the idea. Most current liabilities, unless the current liability is unearned revenue, most current liabilities have the word payable after them. You have to pay cash. Accounts payable is typically reserved for paying the suppliers we purchase inventory from. So we're going to look at these two accounts together. Now, inventory is an asset. So it has a beginning and ending balance. On the left, accounts payable is a liability. beginning and ending balance on the right. Now, we're going to assume a perpetual inventory method. You're saying, what's that? That's why God invented Google. Here's the idea. A perpetual method in the financial accounting records, we update inventory every time something is bought or sold. In a periodic system for financial accounting, we update inventory how often? No more frequently than we have to, which is once a year. Okay? You're saying, well, what business in their right mind would only update inventory once a year? No business would. But our financial accounting records, the only records a business keeps? No. So they're going to have other records that would keep track of inventory. We're assuming a perpetual method. So when a company buys goods on account, when they purchase goods on account, see this right here is what ties those two accounts together. When you purchase inventory on account, inventory goes up and accounts payable goes up. Now, we buy the stuff so customers will come in and eventually buy it from us. So, a perpetual system, you update every time something is bought or sold. So when a customer comes in to buy something, what do? You debit cost of goods sold and you credit inventory. And then eventually, we want to keep our suppliers happy, so eventually we pay our suppliers. When you pay your suppliers, you credit cash, you debit accounts payable. So again, that's not incredibly complicated, but that's the only account to analyze. It involves two accounts. But again, here's the idea. This, and this. Where do we always get our beginning and ending account balances for the analysis we're doing here? Where do we always get that information? From the beginning and ending balance sheets. Then, where else are you going to get an account? You're not going to get account balances for assets or liabilities anywhere else but the balance sheet. Where am I going to find cost of goods sold? Well, it's a camouflage expense. See, it's the only expense that doesn't use the word expense. So typically, the biggest expense in our income statement, we do not use the word expense in it. Just, what makes accounting fun. So, if I know those 5 things, can I solve for cash paid for inventory? Yes, I can. Now, I do that two-step process. Over here, I work with this account. If I know the beginning and the ending balance, and I know cost of goods sold, I can get purchases. Then once I get purchases, bring that around, plug it in here. Then, once I know this, and this, I get that. So again, it's what? Understanding how the pieces fit together. And here today, this morning, we're doing that on a more micro basis. So that is our biggest expense item. The rest of our expenses will all fit in the following 2 categories. just like revenues. With revenues, we could either have the revenue come first, and the cash receipt come second, or we could have the cash receipt come first and the revenue come second. This here we used unearned revenue. Here we used accounts receivable. Same idea happens with expenses. The expense can happen first, and then the cash is paid, or the cash could be paid first and the expense can happen second. Okay, I use something up. I use up electricity. The electric company sends me a bill, I write the check. Expense happens first, cash is paid second. This involves a liability, something we call an accrued payable. Cash is paid first. Did any of you have an auto insurance company that says, yeah, just pay at the end of the 6-month coverage period? No. Insurance companies, you have to pay in advance. Rent, you have to pay in advance. So there are certain items that we pay for them first, and then we use up the benefit. Because remember, that is our most basic definition of an expense. An expense is what? It's a benefit used up this period. So down here, this is going to be an asset. We call these prepaid expenses. So just like up here, we had two possibilities with the revenue. Down here, two possibilities with the expense. Now, there are multiple different expenses that can fit here or here. We'll do one illustrative example but for each, but the template will work for all of them. Okay, this is going to be a specific example of an accrued payable. Say utilities payable. That'll be our specific example. It's a liability. So we get our balances always from the balance sheets, beginning and ending, but because it's a liability, those balances go on the right or the credit side of things. The expense happens first. We use up the kilowatt hours of electricity. They send us the bill, then we pay them. Cash paid. Or, what about wages? Get back to Steve's wages. What about wages for like the sales force or the administrative folks? Wages that could not possibly show up in cost of goods sold. Let's look at another example right beside it. Wages payable. We typically don't pay our employees in advance, do we? They do the work and then we pay them. So the labor is used up first and then we pay for the labor. Just like the electricity is used up first, then we pay for the electricity. And you see the two accounts, they look identical in their format. Now, we have two accountants in the room over here, and you notice they always sit side by side each other. It's like, if they ever come at us, let's get our slide rules and calculators. Probably fight them off and get out of the room. Okay, and that's a very noble strategy. If that ever happened, I'd probably join in with them, and the three of us stand a pretty good chance of surviving. Our slide rules would probably be a little banged up. We'd live to do adjusting entries another day. Okay, which is why I'm bringing this up, because you two are probably thinking, wait a minute. We only use wages payable when? At the end of the year for the adjusting entry. Because during the year when we pay payroll, we just, and let's forget about all those payroll taxes. You're like, I wish. Okay, but it's pretend. We'll pretend this morning for a few minutes. In a world without payroll taxes, what do you do when you pay wages? You debit wage expense, you credit cash. You only use wages payable once a year. But that is when you're wearing your hat when you are preparing statements. What hat are we all? It's a one-size-fits-all hat. It doesn't fit all very well again, but one-size-fits-all hat. We're not wearing preparer hats right now. We are wearing after-the-fact analysis hats. So the way we analyze does not necessarily have to be the same way that we would prepare. So for analysis purposes, you had some balance in wages payable from your adjusting entry last year. Had some balance here for your adjusting entry this year, and whether you do reversing entries, you don't think reversing entries, you don't even need to know. However you do those kinds of things, however the statements are prepared is immaterial. See, analysis is a different task than preparation. So for analysis purposes, what do? We pull these two amounts, here and here, we pull them off of the beginning and the ending balance sheet. We pull this off of the income statement, and then we solve for cash paid for wages. Do the same thing over here if we wanted cash paid for utilities. So again, this is all about analyzing after the fact. Little footnote for the accountants in the room. You guys benefit too. That was the biggest change in accounting education. When you guys were trained, and you were both accounting majors, so this is what you needed. You were trained to prepare the statements. But back in the mid-'80s, something called the Accounting Education Change Commission came along. Because here was the deal. Every business major took Principles of Accounting 1, Principles of Accounting 2. And as accounting professors, we taught all those folks as if that was the first class in the accounting major. Most of those folks were not going to be accounting majors, and that made not only those folks, but the people who would have had to teach them if they had them, happy. So it made everybody happy all the way around. And so in the mid-'80s, we started to think, you know what? Most of the people taking introductory accounting do not need to be taught how to prepare things. Instead, they need to be taught how to analyze things. That's why if you read the literature today, you'll hear people talk about a preparer perspective versus a user perspective. And we're looking at you guys here in the room as users, people that will take the finished reports and analyze them. Now, when you're wearing your accounting hat, when you do that, users may come to you and ask for your help in analyzing. So even accountants, by the time we're done with this whole thing of training up an accountant, we have to be able to wear both hats. Have to be able to prepare it, but also actually help the users analyze what's going on. So, utilities payable, wages payable, taxes payable, interest payable, just about anything with the word payable in it that shows up in current liabilities is going to be analyzed this way. Okay, our next category, prepaid expenses. Now, these are assets, and this again fits with stuff we talked about last night when we said basically there are all assets fit into one of two categories. And the first category was what? Expenses in waiting. Because these assets, whether it's a building, piece of machinery, or office supplies, all assets are purchased. Why? Because they're going to be useful in the business. So eventually all assets get used up. So these prepaid expenses are assets that will very quickly become expenses. A building or machinery is also an asset that will eventually, over a much longer period of time, become an expense as its benefit is used up. But let's go ahead and use prepaid rent. Sorry, example. Okay, again, this is an asset, so the beginning and ending balances show up on the left or the debit side. It's prepaid, so we pay our rent at the beginning of the month, beginning of the year, whatever payment period we're using, cash is paid, and then eventually the benefit of the rent is used up. We have an expense. So I get those two items from the beginning and ending balance sheet. I get that item from the income statement. And I solve for that item. Now another prepaid expense. Supplies. This is the tricky one because nobody ever calls it prepaid supplies. Okay? And this is the only prepaid expense made famous by a Dilbert compilation book. You all should have on your shelf somewhere, How to Make a Fortune by Stealing Office Supplies. Okay? Scott Adams classic. And we all secretly, our inner Dogbert, you know, what does Dogbert do when he just doesn't want to deal with someone? Takes his paw and goes, bah! We all are inner Dogbert. Every so often we want to do that. And A, we don't have a paw, and B, we resist the urge that we identify with that. So, beginning and ending balance, you buy the supplies first. So cash is paid, then you use them up. And the expense happens. Prepaid insurance would look just the same. So, what we've got then, we've got 4 let's make it 5 types of accounts. For revenues, we've got the revenue comes first, the cash receipt comes second. That's accounts payable or accounts receivable. That's type 1. We've got the cash receipt comes first, the revenue comes second. That is unearned revenue, that's type 2. Then for cost of goods sold, we have to analyze 2 accounts together. Inventory and accounts payable, it's type 3. Type 4, the expense comes first, the cash payment comes second. That's an accrued liability. Type 5, cash payment comes first, expense comes second. That is a prepaid expense. So, of every account, every operating account that you might choose to analyze, it's going to fit into one of those 5 categories. Which brings us to the next step here. Direct and indirect, the 2 methods for computing operating cash flow. What we have just been doing here so far this morning is the direct method. If you're doing the direct method for operating cash flow, you're not just giving me a bottom line number. You're taking every item on the income statement and converting it to a cash flow amount. So sales revenue is in the income statement. Sales revenue, you go through accounts receivable and unearned revenue, you convert that into cash received from customers. Cost of goods sold on the income statement. You go through accounts payable and inventory and you convert it into cash paid for inventory. Wage expense. You go through wages payable, cash paid for wages. Rent expense. You go through prepaid rent, cash paid for rent. So basically the direct method, you are going line item by line item down the income statement. You are finding the relevant balance sheet account and doing what? Converting the income statement, revenue, or expense item into the corresponding cash flow item, which is what we said. Remember we did this last time. Revenue minus expense equals income. Cash received minus cash paid, cash flow. And then in between these two, non-cash current assets and current liabilities. So, and that's exactly what this process this morning, we've been looking at what it's been doing. We've been taking an income statement item, we have worked through the relevant current asset or current liability account and got the equivalent cash flow item. So, when you're doing operating cash flow, the direct method, that's what you're going to be doing. We're going to look at an example, Robin's Boutique. in our next session. And that example is going to illustrate how you guys are going to use Bauer Manufacturing Industries. But that's what you're going to have to do for your first computational assignment. For Bauer, all you're given is the beginning and the ending balance sheet and the income statement. What you're going to do for that first assignment is you're going to give me operating cash flow using the direct method. So you're going to do your T account analysis. Now, the indirect method is a little different. Instead of item by item, the indirect method just gives you a bottom line amount. So the indirect method we get that bottom line amount by adjusting net income. So we haven't yet looked at how we would do this indirect method, how we would adjust net income, so that's where we want to proceed next. That's going to be your first assignment. Now, if I was you, and I'm not, we finish up here today, and pretty short order we go into the holiday break. If I was you, I'd try and knock out at least that first assignment here before Christmas happens. Because here's what I think will happen. You can take the notes today, it can make sense, but if you let that set for a couple, 3 weeks, and then after the bowl games are over, either Florida State or Auburn has been crowned the BCS champion. And, January. It's not going to be nice till March, April, or May, which is really sort of the yicky time of the year. That's why God made Big Ten basketball, right? So, if you let that set for a couple, 3 weeks, what is going to seem, however clear it seems this afternoon when we're done, if you just let it set for a couple, 3, 4 weeks, it is probably going to seem sufficiently less clear then. So that would be my suggestion, to try and attack this much more quickly. Sounds just like Scrooge, you're saying. Like, he's my role. Okay, so the indirect, how do we do it? 10:30. I was supposed to quit at 10:04. I'm going to go to probably 10:15. I'm going to take some of Evan's time. He'll probably have a shorter lunch. We'll see what we start. Years ago, when we'd have maybe 3 different professors all teaching one day, by the end of the day, it was amazing how messed up the schedule was. Okay, the indirect method, we're going to start with net income. And the first thing we're going to do we're going to subtract out any gains that were included in the net income, and we're going to add back any losses. What that does is that removes non-operating items. Remember last night, the flower shop? When I sell a dozen roses, if I'm a flower shop, that is a revenue. When my delivery van gets used up and I have to replace it, and I sell the old one, I have either a gain or a loss on that sale. Why is that? I'm a flower shop. I'm not in the business of buying and selling delivery vans. Now, if I was a used car dealership and I sold a delivery van, it wouldn't be a gain or loss item, it would be a revenue, because the car dealership is in the business of selling vehicles. So, a $10,000 gain. If that gain wasn't present, net income would be $10,000 smaller. So that's how you remove the effect of a gain, you subtract it out. $10,000 loss makes net income smaller, so how do I remove the effect of a loss? I add it back. Okay, step 2, I add back depreciation expense. Now, why do I add that back? Very good. It is a non-cash flow item or a non-cash flow expense. So my dad buys a tractor for $100,000. Let's say it's got a 40-year life. So every year, 1/40th of the benefit is used up, approximately. So 1/40th of the $100,000 is $2,500. So every year you take $2,500 out of the asset and move it down to the expense. How do we do that? That process is called depreciation. So you debit depreciation expense, you credit accumulated depreciation. No cash flow is involved with the depreciation expense entry. If it's like Scrabble and you rearrange the letters, I think you can get cash. That's the only way. You are not allowed to do that in accounting. Not even on your most bored day are you allowed to do that. So, when my dad bought the tractor, there was cash flow then. But that cash flow shows up as an investing activity, not an operating. And then, the last step you're saying, that's the NCAA, you doofus. It's like, no, it's not actually. I know that's the National Collegiate Athletic Association. Whenever I want an investigation conducted with perfection, they're the guys I think of. Because they handle that Miami thing so well. No, this is non-cash current assets. And this is current liabilities. So, the next step we have are adjustments I'm going to call it adjustments in the slack accounts. Because remember, it was those non-cash current assets and those current liabilities that took up the slack that allowed the revenue or expense to happen at one time and the cash flow to happen at the other. Now, so for every non-cash current asset, the balance either goes up or the balance goes down. For every current liability, the balance either goes up or the balance either goes down. So every non-cash current asset is either here or here. Every current liability is either here or here. The question is, plus or minuses, where do they go? Okay, this is going to be like a little onboard footnote. if accounts receivable goes up, the ending balance has to be greater than the beginning balance. I mean, that's by definition when an account balance goes up. So for accounts receivable, what is the only way that the balance in accounts receivable can go up? What must revenues be in relation to expenses? Higher. Very good. So revenues have to be higher than or greater than cash received. I said expenses, didn't I? I meant to say cash received. So for this balance to go up, revenues have to be greater than cash receipts. Well, revenues are included in income, and over here on this as yet unextended portion of the board, I want operating cash flow. So I'm going from income to cash flow. If I'm going from revenue to cash received, if this is greater than this, if I'm going from this to this, what do I do with that increase to get from the bigger number to the smaller? I have to take it out or subtract it. So I would subtract the increase, which means I would add back a decrease. And then liabilities are the opposite of assets, so the plus and the minus get reversed. So, I mean, if you think it through in your head without drawing the T account, if receivables are going up, what does that tell me? It says I got revenues that haven't yet been what? Backed up with cash receipts. So my income's going to be higher than my cash receipts. If inventories are going up, what does that tell me? That tells me I'm accumulating inventory that I've eventually paid for that hadn't been sold yet. So I'm paying out money for inventory, but it hadn't showed up as cost of goods sold. So if inventory goes up, that says my cash payments are greater than my expenses. So you can sort of think it through like that. But you see, an expense is the opposite than income. So I think this is the easiest account to analyze. And once you get the sign here, you've got the signs over here. And then all of that equals operating cash flow. So that is the indirect method. So which one should you use? It all depends on what you're after. The indirect method is certainly quicker. If all you're after is a single number, what was my operating cash flow for the period? The indirect method will get you there quickest. But if you want the detail, what's the cash flow associated with individual line items? Then you have to use the direct method. But that is your first assignment. Your first financial analysis assignment is for Bauer Manufacturing Industries to compute operating cash flow the two different ways, the direct method and the indirect method. And don't just give me final answers. I want to see your supporting work. Okay? So you can either, and if you want, the Robbins Boutique solution is out on Blackboard. So I've in Microsoft Word, I've set up